CRE workouts entering a more forced phase. What investors and business owners need to know right now. And the commercial real estate market is entering a new chapter in the current distress cycle. And for the past several years, many lenders have relied on extend and pretend strategies, granting extensions and hoping interest rates would decline enough to restore refinancing opportunities for their clients. And today, that era appears to be ending. With approximately $1 trillion in commercial real estate debt maturing this year, lenders are becoming increasingly selective about which properties and sponsorship groups warrant additional support. So borrowers who proactively address challenges are finding opportunities to restructure debt, while those waiting for market conditions to improve may face far more difficult outcomes. So for commercial real estate investors, developers, and business owners, understanding the changing workout landscape is critical. Why CRE workouts are becoming more common. Well, many commercial loans, particularly those originated between 2020 and 2022, were structured in an extremely low interest rate environment. And at that time, interest rates ranged from, say, 3% to 4%. And when rates are that low, cap rates were compressed pretty low as well, and property values reached record highs, and debt service coverage ratios still appeared strong because of the lower cost of financing. Fast forward to today, interest rates are often 7% or even higher in some cases. Refinancing proceeds have declined as a result, and property values also have adjusted downwards. So cash flow margins basically have tightened. And the result is a growing number of properties that cannot refinance into replacement debt without significant borrower equity contributions. So many owners right now are facing difficult decisions. One is inject additional capital, or two, do we sell at a discount, or three, do we negotiate a workout, or four, do we bring in new equity partners, or five, do we just hand over control? The end of extend and pretend. For much of the current cycle, lenders preferred loan extensions rather than foreclosures. And why? Because property values were uncertain, market conditions were volatile, and interest rates were expected to decline. Lenders hoped for fundamentals that would recover. However, now, many lenders are now recognizing that certain assets face structural rather than just temporary challenges. So this shift has created a new environment where lenders increasingly expect borrowers to communicate early and often, to provide updated financial reporting, to present realistic business plans, but also to contribute additional equity when needed, or to demonstrate operational improvements. And the strongest borrowers are approaching lenders before their maturity dates become crises. So let's talk about why capital stacks have become more complicated. And one major difference between today's market and prior cycles is the complexity of capital structures. And many commercial properties now contain multiple layers of financing. There's often senior debt, and this is often provided through, say, a bank or a credit union or a life company or a CMBS lender or through mezzanine financing. And there's also additional leverage layered behind senior debt. So you may have preferred equity for your investors. And these are for investors seeking higher returns, and they may provide preferred equity capital as long as they get repayment priority. There's also private credit. So private debt funds have become increasingly active participants in commercial real estate financing. But there's also EB5 capital, and many development projects contain foreign investment capital through EB5 programs. The challenge, you ask? Well, every stakeholder has different objectives. And a restructuring that benefits the senior lender may hurt the mezzanine lenders. And a preferred equity solution may dilute the ownership. And an extension may not satisfy the private credit investors. And as a result, workouts frequently take longer and require extensive negotiations. Receiverships are becoming more common. And historically, receiverships were viewed as a sign of failure. And today, they're increasingly viewed as a business tool. So, what is a receiver? Well, a receiver is an independent third party professional appointed to oversee a property during its distress period. And the receivers may help stabilize operations or complete the construction projects or manage the tenants, but preserve the cash flow and protect the asset value. And in many cases, lenders and borrowers agree to receiverships voluntarily because they create breathing room while long term solutions are being negotiated. So rather than signaling defeat, receiverships often represent an effort to maximize recovery and preserve equity for everybody involved. Let's talk about multifamily distress and how that's growing. And office properties continue to dominate the headlines in that category. However, multifamily assets are increasingly drawing attention. And several Sunbelt markets have experienced slowing rent growth, increased concessions to keep the buildings filled, but elevated operating expenses as a result of rising insurance costs and property tax increases. But also, there's a large amount of new multifamily supply. So, at the same time, many acquisitions were also underwritten using aggressive assumptions regarding rent growth and the ability to refinance later. And as these assumptions collide with reality, more multifamily loans are entering special servicing or restructuring discussions. And Texas has become a focal point of this trend, particularly among properties that relied heavily on value add execution strategies. And distressed debt investors are watching closely. Private lenders and distressed debt funds continue to raise capital for opportunities. However, many are taking a more selective approach, and investors generally prefer stabilized properties with performing cash flow or discounted purchase opportunities, strong sponsorship. And they're often less interested in, say, a highly complex capital stack with lots of partners or major construction risk in a project or significant operational deficiencies that they think might be difficult to overcome, but also assets that are going to require extensive repositioning. So, this selective environment creates opportunities for well positioned borrowers while also increasing pressure on weaker assets. So, what borrowers should do right now? And if your commercial property loan matures within the next 24 months, 2 years, now is the time to be preparing. So, you need to review your loan maturity dates. You need to know exactly when those obligations are coming due. We need to evaluate your refinancing options early. And do not wait until the months before maturity to do so. It won't take long, promise. Give me a call. But also strengthen your financial reporting. So you need to provide lenders with accurate and transparent information. Do what you can now to improve property performance. So focus on occupancy and your collections, but also retaining tenants and your expense management. Every penny saved is a dollar earned, right? But you can also explore capital solutions. So you may need to consider, say, new equity partners or some preferred equity or mezzanine capital or supplemental financing or partial paydowns. And communicate with your lenders. Borrowers who engage early typically achieve better outcomes than those who avoid the difficult conversations. So, final thoughts for the day. Commercial real estate workouts are entering a more forced phase, and the industry is transitioning from patience to accountability. And lenders are no longer relying solely on future rate cuts to solve refinancing challenges. Instead, they are evaluating which properties, which business plans, and which sponsorship groups have a realistic path forward. And the owners most likely to preserve equity are those who act early and understand their numbers and present realistic valuations, but also those who improve operations and are willing to collaborate with lenders. Commercial real estate cycles create both risk and opportunity, and investors who address problems proactively often emerge stronger, while those who delay action may find decisions being made for them. And if you have a loan maturing in the next 12 to 24 months, now is the time to begin evaluating your options. And that's what I'm here for. Reach on out. My website is billrapp.comloan.com. You can start a pricing quote, and you can also schedule a consultation so we can have a conversation. That's it for the day. Thank you for watching. Take care.